We now turn our attention to the discussion around the dividend policy of the peers of our company under consideration. So, if you remember in the previous section, we have already seen that in assessing any company's dividend policy, it's important to understand how much dividend the company paid versus how much they could have paid, which is basically the dividend plus any buyback that the firm may have done versus the free cash flow to equity, which is the potential dividend that could have been paid by the firm. And we try and gauge as to what this number is versus the FCFE that the company has shown. And then try and figure out if the company has paid lesser than the FCFE, they must be reinvesting. If they are reinvesting, we try and compare the ROE versus the cost of equity and see if the company is generating value for shareholders over that period, right? Now, let's say we do this and we find out that's all fine. Sometimes we get this data, sometimes we may not get this data. Even if we get the data, it may not necessarily give us complete information in the context of our requirement. So we may want to kind of look at, what's the peer group doing? What are peer companies or peer group paying in terms of dividend, because that will tell us a little bit about the industry and what kind of reinvestment is available in the industry. So in the absence of anything, the best place is to be at a dividend number which is close to what your closest competition is paying, because that would have done in a sense what kind of risk analysis is needed. This, remember, is not the ideal scenario. It's only in the absence of anything else that you are saying that, okay, I'll look at the competition and see what they are doing and then try and gauge whether my firm is doing something similar or not, right? So that's what we're going to do. We're going to look at CEAT tires and we're going to look at MRF, and we're going to try and check what kind of FCFE they had and what kind of dividend they have paid. We'll also try and calculate what is their dividend payout ratio and what is their overall numbers in terms of the data that we see in terms of FCFE versus the dividend that is there, right? So let's begin. Let's start with these one by one. We will go back to our Excel file and start working with MRF first and then put in the numbers for CEAT. So that's our Excel file, and we're going to look at, let's say, MRF tires as the first data point. And the message in terms of what kind of information we have, let's try and identify if we can reach the financial statements directly and try and see. So here we go. So there is a financial statement that is available for MRF, consolidated balance sheet. One interesting thing we will have to note is that this is as on 31st March 2016, but if we go on the right and we look at the previous one, that's on 30th of September 2014. So interestingly, they have changed the accounting year. And so this data that we see here, wherever it is periodic, is for 18 months. And this data is for 12 months. So we have to be careful in looking at data like profit, etc., because the data might be for 18 months, and hence we have to be careful looking at that number, right? So that's something that we have to be assessing carefully when we look at that, and we'll take care of that. Let's plug in the numbers that we see here in terms of our Excel file. We'll need the long-term borrowings data. This is in rupees crore, remember, so 1485 and 1198. So we can put in the long-term debt as 1485 and 1198, and in the case of MRF, let's write this as 2014 so that we understand that there is an 18-month period here. So we can put 18 months here so that that information does not get lost anywhere. We have that information with us, right? Current liabilities. So current liabilities are at 2895 here. So that's 2895. And we have 2623. We have 2623 here. Current assets less cash. So we're going to remove cash and we're going to remove current investments from here. So that's 6057 equals to 6057 minus We're going to subtract 1855 and we're going to subtract 126. So we're going to subtract 1855 and 126 and we get the current assets here. Last year 5379, so that's equal to 5379 minus 727 and 945. So 727 and 945. I'm ignoring the rounding errors here, right? Net profit for the period that we get is 2366. So that's the profit for the period, 2366. I'm going to put that number here. What is the depreciation for the period? That's 737. So we get 737 as the depreciation. Capital expenditure, let's try and get it from the investing activities. Purchase of fixed assets, that's about 2313 is what we have this year. So we go and put in 2313. Change in debt is calculated from here. That's A minus the previous year number. Similarly, change in current assets is 4076 minus 3707. Change in current liabilities is 2895 minus 2623. That gives me a free cash flow to equity of 980 crores, right? We will need to search what kind of dividend they have paid. So we'll have to search for the dividend data. If they have mentioned it clearly, this, remember, is the cash number. So that might in the cash flow. So this is the appropriation. This is what is proposed for the year and the data for the previous year. So dividend interim is 2.54, final is 39.87. And if you look at the tax on dividend, you put all these three together, that's 2.5, 40, and 8.5. So 11 plus 40 is what's going to come. That's about 51, right? That's not a big amount as compared to what kind of free cash flow to equity they are generating. This is in crores, remember. So in terms of the dividend that they are paying, this is a small amount that is being paid as compared to what we have seen in terms of the FCFE that they have. So that's for MRF. We can try and find out what equity do they have. So let's quickly go to the income statement and balance sheet, and let's put in the total equity number that they have. That's 6856. That is there. So we can put in the equity number as 6856, and we can calculate the return on equity. That's my net profit divided by 6856. So huge return on equity, nearly 35% as opposed to the earlier data that we had seen for Apollo tires, correct? So 35% return on equity is what we see for these guys. We can also calculate these numbers for the previous years and see what kind of data they would have. Broadly assuming, while we'll have to go beyond one particular year to figure out, remember the profit is for 18 months and free cash flow is also for 18 months. Dividend may be affected because of that a little bit, but that still does not solve the entire problem. They have a lot of money, but they're not really paying it out as dividends as of now, right? That's with MRF. Let's turn our attention to CET pretty quickly, and let's try and see where can we find the financial statements, the consolidated ones for CET. There we go. So let's start right away with the equity itself. This is in lakhs. Let's also convert this in crores. So I'm going to put in 2064 on the Excel file here. Let's put this here. So that's 2064, and let's go up and put in the debt numbers first for this year and previous year. We will see the debt is at 589.9, so that's 590 and 354. 590, 354. We go further, we look at what kind of current liabilities do these guys have. That's 1253 and 1594. 1253 and 1594. That's the current liabilities. Current assets less cash. So current assets is 1585 this year minus 107 minus 40. Right, so 1585 minus 107 minus 40 is my current assets less cash. Last year 1920 minus 123 minus 312. So that's 1920 minus 123 minus 312. Right? Again, not really bothering too much about rounding errors. Let's look at depreciation numbers, 107. Let's look at profit after tax numbers. That's 444. So 445 is what I'm going to put in here. Depreciation is 107. Capex is going to come from my investing activities. Purchase of fixed assets, including capital work in progress, that's going to be 706 crore approximately, right? So 706 crore. I can just copy and paste these headers. I can directly calculate this and put it here. So there's a negative cash flow this year. Let's see what kind of dividend they have paid. Once again, we will search for the dividend item and try and figure out if we get to this in terms of the data. Yeah, so proposed dividend amount per share. This year, they have not really given any dividend as final dividend. Interim, they had given 11.5 rupees per share. So that accounted at 46 crore or something. Last year, that number, so tax is going to be about 46 and 7. So that's about 53, 54 crore. Last year, this number was about 45 crore. So this number is 54 crore. Last year, this number was 45 crore. For these guys, it was about half of the number last year, right? Now, in one case, there is a lot of free cash flow to equity, and they're not really paying too much dividend, but they're generating a lot of return on equity. In the second case, also return on equity is superior to what the firm is saying, but while they have paid interim dividend, they haven't really gone ahead and paid final dividends, right? So effectively, the reasoning there possibly is that they're doing a lot of capex, and hence the firm is not really paying that amount. In the context of the ratios, when we compare these, while we do not get a definitive assessment just looking at this set of numbers, we might get more information if we look at the previous set of numbers, right? So if you look at MRF and you look at the dividend paid last year, that would have been small as well. That wouldn't have been as big as you see it. But return on equity must have been fairly superior. Let's plug in those numbers very quickly. So for these guys, see it. If we want to put in the profit number for last year, that would have been about 314. So that's 314. And if we want to put in the net shareholder equity worth, that's 1682. So when you compare, last year was also about 19%. Let's do that for MRF as well very quickly. So we have the share capital and reserves for the last year. That's 4539. So we can put in 453 and 9. And then we can look at, so this will be 0 right now because we have not put in the net profit number. Let's put in the net profit number. That's 900 odd crore. 908 crore of net profit. So that was 20%. This year there has been significantly higher number, and that's because it's an 18-month number. It's not the growth as per year, but even if we kind of consider that it's a if we scale it down to arrive at the number, so we can basically assume that this return has to be then multiplied by, to get a correct picture, multiplied by 12 by 18. Right? So that's around 23%, because obviously the profit for 18 months when divided by any equity number is going to give you a bigger picture than what return on equity is. So practically it seems the industry is getting a return on equity of about 20 to 23%. It's increased over the last year. MRF doesn't pay too much dividend. CET does pay steady dividend, irrespective of whether they are having enough cash flows or not. But even otherwise, assuming that all of them have a similar beta or close to a similar beta, they would be generating more on return on equity when compared with their cost of equity. So to that extent, most of the sector is paying reasonable dividend amounts. MRF seems to be paying lesser for some reason. which we can decode further and try and figure out if they are doing any kind of buyback at some point of time or something of that sort is on their annual. Uh, but they haven't really paid too much dividend that they could have paid. They could have paid more, but they haven't really paid that dividend, right? That's how you go about doing your analysis for the peers. It would be a great idea to go back a couple of years and do the data starting from 2012, 13, 14, 15, and then check whether year on year if there is a good amount of payment that has happened, right? If you look at the payout ratios, for example, they are not going to be very huge for these guys. Let's actually quickly calculate the payout ratios as well. And that's dividend divided by the profit that the company has had. So you get about 3% payout ratio. And if I just drag it on the right side, we get 14 and 12% for CET. If we go to Apollo Tires and we try and look at the payout ratio here, we calculate the payout ratio here. That's going to be my dividend that is given here divided by my profit number, which is here. So we note that in terms of payout numbers, CET is more comparable to Apollo Tires. MRF for some reason does not pay out too much dividend. They pay out very little amount of dividend. They hold most of the money, probably looking at expanding capacity as it appears here. They're reinvesting in this business, and so from profit of 2366, they end up with a free cash flow of only 980, which means there is a lot of investment in the business that's going on, which possibly might explain why the dividend payout ratio is less and why the dividend paid is also less. That's how you go about doing this for the peers. As we end this particular section, what would your views be about the dividend policy of Apollo Tyres versus its peers? Thank you.